In the world of business, the terms C Corporation and S Corporation are more than just random letters. They represent two distinct types of business entities, each with its own unique set of advantages and limitations. Imagine a corporation as a ship sailing on the vast ocean of commerce. The captain and crew, or in our case the business owner and employees, work diligently to navigate the tumultuous seas of market trends and financial fluctuations. But the type of ship they're navigating, whether it's a C corporation or an S corporation, can significantly influence their voyage and ultimate destination. So what exactly are these two types of corporations? Well, the C corporation, or simply C Corp, is the standard corporation as per the Internal Revenue Service, or IRS. On the other hand, the S corporation, or S Corp, is a special type of corporation that enjoys certain tax benefits. Now, at first glance, they may seem quite similar. They both provide their owners with limited liability protection, meaning the owner's personal assets are protected in case the business falls into debt or faces a lawsuit. They also both have a separate legal identity from their owners, meaning they can enter into contracts, own assets, and even sue or be sued in their own name. However, the differences between the two start to emerge when we delve deeper into how they are taxed, their ownership restrictions, and their management and operational requirements. The purpose of this video is to provide a detailed comparison between a C Corp and an S Corp, shedding light on these differences to help you understand which might be the best fit for your business aspirations. So buckle up as we delve deeper into the world of C and S corporations. We'll be unveiling the C Corporation in our next scene, followed by a deep dive into the S Corporation, and finally a head-to-head showdown between the two. It's going to be an exciting journey, so stay tuned. Let's first unravel the mystery of the C Corporation. A C corporation, often simply referred to as a corporation, is a distinctive form of business structure that offers a unique blend of benefits and responsibilities. It's like a separate individual in the eyes of the law, with its own rights and obligations. This legal separation from its owners, known as shareholders, is one of its defining characteristics. One of the key advantages of this separate legal entity status is limited liability. In a nutshell, this means that if the corporation runs into financial trouble, the personal assets of the shareholders are off limits. The most they stand to lose is their investment in the company. This makes it a relatively safe option for those who want to invest in a business but are wary of personal financial risk. Another characteristic of a C corporation is its perpetual existence. Unlike a sole proprietorship or partnership, which could end with the death or departure of an owner, a C corporation continues to exist even when shareholders come and go. This stability can be a real advantage when it comes to long-term planning and attracting investment. Now let's talk about taxes. This is where things can get a bit tricky with C corporations. You see, they're subject to what's known as double taxation. This is because the corporation is taxed on its profits, and then the shareholders are taxed again on the dividends they receive. It's like a two-layer tax cake, and it's not everyone's favorite flavor. However, it's not all bad news on the tax front. C corporations can also benefit from certain tax deductions and credits that other business structures can't. Plus, the corporation's profits can be retained and reinvested in the business without triggering additional tax. So that's the C corporation for you, a separate legal entity with certain tax implications. Now let's shift gears and explore the terrain of the S corporation. The S Corporation, named after Subchapter S of the Internal Revenue Code, is a unique business entity that combines the limited liability of a corporation with the tax benefits of a partnership. Just like a superhero with its own set of superpowers, the S Corporation shines in its own light with distinct features and attributes. The first superpower of the S Corporation is pass-through taxation. Unlike traditional corporations that face double taxation, S corporations allow profits and losses to flow through to the shareholders' personal tax returns. This means that the company itself is not subject to corporate tax rates. Instead, shareholders pay tax on their share of the company's income at their individual tax rates. A bit like having your cake and eating it too, isn't it? However, every superhero has limitations, and so does the S Corporation. It comes with shareholder restrictions. Specifically, an S Corporation can have no more than 100 shareholders, all of whom must be US citizens or residents. Additionally, S Corporations can only issue one class of stock. This limits the flexibility to distribute profits and losses among shareholders in different ways. But don't let these limitations deter you. The S Corporation has its advantages too. It offers the protection of limited liability, which means that shareholders are not personally responsible for the company's debts and liabilities. And unlike traditional partnerships, S Corporation status allows for the easy transfer of ownership without disrupting business operations. The S Corporation then is not just a business entity, but a strategic choice. It offers the benefits of limited liability and pass-through taxation, but it also comes with its own set of restrictions. Choosing to operate as an S Corporation requires careful consideration of these benefits and limitations. The S Corporation then offers a different set of benefits and limitations, particularly in terms of taxation and shareholder restrictions. Now that we've surveyed both territories, it's time for a face-off C Corporation versus S Corporation. Let's dive into the main differences between these two types of business entities. Firstly, let's talk about taxation. In a C Corporation, profits are taxed at the corporate level and dividends are taxed again at the individual level. This is often referred to as double taxation. On the other hand, S Corporations are considered pass-through entities. This means that the corporation itself is not subject to federal income tax. Instead, profits and losses are passed through to the shareholders, who report this income on their personal tax returns. Next up is liability. Both C and S Corporations offer limited liability protection. This means that shareholders are not personally responsible for business debts and liabilities. If the corporation goes under, your personal assets are protected. Now, let's consider existence. A C Corporation has a perpetual existence, meaning it continues to exist, even if the owner leaves or passes away. An S Corporation, however, has a more fragile existence. If a shareholder dies or sells their shares, the S Corporation status could be terminated. Lastly, we have shareholder restrictions. A C Corporation can have an unlimited number of shareholders and multiple classes of stock. It can also have non-US citizens as shareholders. An S Corporation, on the other hand, is limited to 100 shareholders, one class of stock, and all shareholders must be US citizens or residents. As you can see, choosing between a C and an S Corporation depends largely on the specific needs and goals of your business. So, how do you decide between a C Corporation and an S Corporation? The answer lies in understanding your business goals, tax implications, and shareholder restrictions. Firstly, consider your business goals. Are you planning to reinvest your profits back into the company or distribute them to shareholders? C Corporations are ideal for reinvestment strategies, while S Corporations suit those planning to distribute profits. Next, think about tax implications. C Corporations face double taxation, but they also enjoy greater tax deductions. On the other hand, S Corporations avoid double taxation, passing income, losses, deductions, and credits to their shareholders. Lastly, consider shareholder restrictions. S Corporations have a limit of 100 shareholders and one class of stock, whereas C Corporations have no such limitations. So weigh your options. Evaluate your business goals, consider the tax implications, and understand the shareholder restrictions before making your choice. Remember, the right choice between a C Corporation and an S Corporation is the one that best aligns with your business goals and aspirations.